Today we're talking to Rick about mortgage rates. How do we work on interest rates for a mortgage?
Sure. So rates can actually vary quite a bit between, given lenders that you're going to talk to, whether you're talking to a big bank or a mortgage banker or a mortgage broker. So initially, like each individual company, there's guidelines in how they're going to determine the rates for part of it. So it's going to be based on like the property type, it's going to be based on your loan to value and your credit score. A lot of that is going to shape what your rate's going to look like that's offered by a given company. Okay. But there's other factors that go into it that determine what kind of rate that company is going to offer you in the end.
Why is it that all these rates are differing? When I see rates advertised, when I talk to different mortgage companies, like why would there be any difference between companies?
Sure, great question. So with rates between companies, it's all going to vary on really what that lender needs to charge, so to speak, based on covering their expenses and their overhead and what they want to make on those mortgages that they're placing with different lenders. So, for example, a broker or a bank, ultimately they're selling that loan to somebody else, unless it's one of the big banks. But they've got to they've got to build within the rate what they want to make and what they need to cover.
So there's a profit component for them.
Right.
That they need to kind of achieve when they're creating a mortgage.
Sure. And so a lot of it just depends on what they need to cover, their expenses, how their teams are structured. So for example, you can go talk to a mortgage guy, and then he works for a team, and then that team is part of a branch, and then that branch is part of a company. Well, they've got to everyone in that hierarchy, so to speak, has to get a piece of the pie. Sure. So this person has to get paid, their team leader has to get paid, their branch has to get paid, their company. So the structure a lot of times will indicate what that rate's going to look like, and in that type of structure, they're going to have to offer you a higher rate because they need more of a margin to cover all of their expenses, to cover everyone that's involved in the deal. So a lot of times it's how a company is structured and set up, and it will determine what kind of rate they can offer you.
Okay, and when we're talking about companies, I guess we would use that phrase for lender. Now, is that the same thing? Is a lender the same as a mortgage company or a bank, or is that a different term for something else?
So there's kind of like three different kinds of lenders. You've got a big bank like a B of A or a Chase. And of course, they've got margins to cover. They're advertising, and they've got real big budgets to cover. So their rates can tend to be higher because of all the things they have to cover and the margins they have to build into that rate. So the more margin, the higher the rate. And then you've got like a mortgage banker, which might be just local like mortgage lender, ABC banker. And then within their structure, they've got a corporate office, and then they've got state branches, and then they've got teams within those branches. So you've got that hierarchy I was mentioning where there's got to be more margin built in because everybody's got to get a piece of it. And then you've got companies like mortgage brokers, and that's what we are. We're a mortgage broker, and that can even vary within brokerage shops because like our team, we're set up very slim. We're a small team. We rely on the resources of the largest lenders in the country that we work with, right? We use their underwriters, we use their systems, and so at our level, we have limited overhead. We're very low on overhead, very low on expenses. We're just one little team, so we just have to make what we're going to make, and then we place the loan with the bank. And there's not all this middle stuff where you've got to add margin to the rate, and we don't need to offer a higher rate.
Right, so you have less people in the pipeline, so less people have to get paid to make it happen.
So, so we can definitely offer the best rate based on the structure of our company, and again, the limited overhead and the way we're set up. So we can definitely, and we're set up that way for a reason, because we want to be able to offer the best rate, the lowest fees, and then we win the business that way.
So if I'm in this process, what questions should I be asking the lender so that I can know I'm getting the best rates?
Sure. So, I mean, you could just ask them some questions like, so how is your company structured, right? How are you
Okay.
guys, like, are you part of a team? Are you part of a branch that's part, like, where's your, where's your corporate office? And ask them some questions like that, because the more they have, like, even if they say, oh, we have our own internal underwriters and this and that, well, they've got to cover that, right? So,
Right.
so
Okay.
the more resources they have as a company, the more of a hierarchy, if you will, then they may not. They may tell you they can offer the best rate, but you'll see based on the rate they're offering and everything they've got to cover in that rate versus a company like mine, you'll see the difference in the rate. So a lot of questions would be, how are you guys set up as a company to offer me the
Interesting.
best rate, and how are you structured? They wouldn't be expecting that. And if they can't explain that, then that's a problem too.
Yeah, wow. Well, that's really insightful. I would have never thought to ask those questions. So thanks for answering that for us, Rick. I
You bet.
appreciate it.
All right.